Hello and welcome to this session in which we will discuss attachment and perfection. Attachment and perfection are concepts that are used in what we call secured transaction. What are secured transactions? Secured transaction is when a debtor purchases something from a creditor on credit, promising to pay later. Or an individual goes to the bank, borrows some money for a particular purpose, and purchase that item with that money. So here's what happens. The person that gave the money, the creditor, the person that lent out the money, there's always the risk that this individual may not pay. So what did we learn about in the prior session? We learned about in the prior session, they can ask this individual to bring a surety, basically someone to guarantee the loan. That's one way to mitigate the risk. Another way to mitigate the risk is to do what? Is to take interest in the item that this person is purchasing. Take interest means if you don't pay us, we have the right to take it back and use the proceeds from the sale of that item to pay off the loan. Why do we do this? To protect ourselves as creditor. So to mitigate the risk of non-payment, the creditor obtains a security risk. We want to have something because we're giving you money and we want to have something in case you don't pay. They will have security interest in the debtor's personal property, and that something is called collateral. That it could be the car that they purchase, it could be the computer that they purchase, the furniture, so on and so forth. And this security interest acts as a legal safety net. So this way I don't have to go to court to bring a judgment against you. I have the right to take it back just on the mere fact that we have this agreement. So this is a safety net for the creditor, making sure the right to the specific debtor's owned item if the payment is not made. So this way it makes it easier for me. I don't have to go to court or hire a lawyer. I can take your item back. In this session, we want to focus on what we call attachment of the security interest and perfection of the security interest. Because the security interest, whatever you took interest in, you want to make sure you have the top priority in case something happened, because sometimes that same item could be subject as a collateral at multiple creditors. So we need to learn about attachment and perfection. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. What is attachment? In the context of security interest, it establishes a creditor's legal claim over the debtor's collateral. Now, for an attachment to actually exist, to occur, certain conditions must be met. The first condition, 3 of them. The first one, agreement between parties. There must be a mutual agreement that the security interest will attach to the collateral, and this agreement must be signed by at least the debtor. Now, this agreement does not have to be in writing. We're going to see. For example, if you hand in the collateral, if you gave the collateral, whatever you are pledging to the creditor, you don't need an agreement. They're in possession of it. They have it. This agreement can be formalized in 2 ways. It could be a written agreement, which can also be electronic, is used to outline the terms. This document must be signed by the debtor to be valid. What does that mean? It means the agreement could be a written agreement, or the agreement could be by the act of the parties. In some cases, an oral agreement will suffice if the secured party physically take possession of the collateral. This is known as the pledge. So if you're putting your watch, your expensive watch, as a security interest, as collateral, and you hand it over to the creditor, that's it. They don't need a written agreement. They have it in their hand. Nevertheless, you might want to have a written agreement, but that's the first party, the first condition, to have an agreement. And again, the agreement doesn't have to be in writing. It could be just oral with pledge. The second condition is the debtor, the person that's borrowing the funds, the borrower, must have some legal right over the collateral. Simply put, they cannot offer something as a collateral if they don't own it or have it. So they own it or they have it. The third condition is the creditor must provide something of value in an exchange. Usually, what do they provide? They're providing the loan or they're selling something on credit. Three conditions: the agreement, the debtor's right to the collateral, and value given by the creditor. Again, the agreement, it doesn't have to be in writing. Let's take a look at an example. Sarah needs a loan of $10,000. She approaches a bank and they agree to give her the loan. As a security for repayment, Sarah offers her car and her car becomes the collateral. Sarah and the bank signs a written agreement stating that the bank will have a security interest in her car if she fails to repay the loan. This written agreement is signed by Sarah to make it valid because it has to be signed by the debtor. Now, what is the debtor's right? Sarah owns the car outright, but she has the right to offer it as a collateral. She has to have it, the debtor's right. She has the right to that car. The value given by the bank is the loan itself, and we have an agreement. 1, 2, 3. So if Sarah fails to repay the loan, the bank can enforce its security interest in the car, meaning they can take possession of it to offset the unpaid loan. Now, sometimes there could be other interest in it, but that's a different story. We'll talk about that later. This process explains how attachment works in creating a legal relationship between a debtor, collateral, and the creditor's interests. Now, here's what's going to happen to Sarah's car. What happened to cars usually? What happened to personal movable property? Think about a car, furniture, computer, tables, chairs. Anything, usually personal property, they don't go up in value, usually, generally speaking. So we have something called after acquired property because the bank wants to protect their interest. The lender wants to protect their interest. And they know if this agreement is for a long period of time and this asset is losing value, let's assume we lend, how much did we lend Sarah? $10,000. Let's assume the car right now is worth $10,000. A year from now, this car could be worth $7,000 and their loan could still be $9,000. And the following year, the car could go down to $3,000 and their loan is worth $8,000. So what happened is the creditors, they want to protect themselves. So there is this concept called after acquired property, refer to a situation where a secured party, the creditor, wants to secure a claim not only on the current asset of the debtor, but also on assets the debtor may acquire in the future. Why? Because they want to have enough collateral. It's better to be over-collateralized rather under-collateralized. So if the person don't pay, at least you can get your money back from the collateral. But if the collateral loses value and the person don't pay, you take back that collateral, but it's not enough to pay you. To make this legally binding, they have to add this in the security agreement. They have to add a clause called after acquired property clause. This clause makes sure that as soon as the debtor obtains any rights or ownership in new property, the secured party interest automatically attaches to this property. So as a lender, they know this and they have to put that clause. And this approaches provide additional security to the creditor, ensuring that their interest is protected even if the debtor's asset portfolio expands. Example: consider a small business, XYZ Widgets, that takes out a loan to expand its operation. The lender is concerned about the ability of the company to repay the loan and seeks additional security belonging to the company's asset. Well, what do? Security agreement with a clause. The lender and XYZ Widget enters into a security agreement that include an after acquired property clause. So 6 months later, XYZ Widget buys a new machine and a delivery vehicle to support expanded operation. As per the after acquired property clause, the lender security interests automatically extend to those new assets. So as soon as XYZ Widgets acquires them. Now, what are the responsibility of the secured party? They have certain responsibilities. 1, filing or providing a termination statement. Remember, we're going to see shortly that to perfect your attachment, you have to file paperwork. And that paperwork tells the world that you have a security interest in that property. But once the debt is fully paid, guess what you have to do? You have to reverse this because this individual might use this property in another transaction. So you have to terminate this statement. The secured party must either file a termination statement with the appropriate or send one to the debtor so they have it on file. This statement formally releases the secured party claim on the collateral. 2, if they ask you for the balance, you're supposed to be sending a statement on a regular basis, letting them know what's their unpaid debt balance. Or upon request, the secured party is obligated to inform the debtor about the remaining balance. This helps the debtor understand how much they still owe. Also, if you have access to the collateral, if you're in possession of that watch, of that computer, of that phone that you're holding as a collateral, you must take reasonable care to preserve it. And it's in your best interest to do so in case the debtor don't pay. You want to sell it. This means you should avoid any actions or negligence that would diminish the value of that collateral. That's great. We learn about attachment. Now, attachment is good, but what you need to do something called perfection. So we learn about attachment. You need an agreement. You need a value. The creditor needs to give a value, usually that loan, and the debtor has right to the property. Now, what should the creditor do? They should perfect this attachment. So the process of attachment in a creditor-debtor relationship establish basic rights for the creditor over that collateral. This means if the debtor default on a loan or obligation that is secured by that collateral, the creditor has the right to seize that collateral. However, that collateral could have many people coming after it, not only you. You're the creditor, but you could have other creditors. That same collateral maybe was sold. Then you have to go back after that individual that purchased it. Or the debtor went into bankruptcy. Now you have to fight over that collateral. So what should you do? You want to perfect your attachment. So the creditor, they want to ensure, for the creditor to ensure that they have the highest priority claim in case something happened, especially over others who might have interests in that collateral as well. Who could be that others? Future buyers, person that purchased that collateral, unsecured creditors, also they borrowed money from another party and they pledge it as collateral, or other priority creditors, any sorts of creditors. They must go beyond attachment and perfect their security interests. So perfection solidifies the creditor's claim. Make your attachment way better. You have now the highest priority. Make it enforceable against third party. Now make sure the perfection cannot be done earlier than the attachment. First you attach, then you perfect. You can be done at the same date, but attachment first. There are 5 primary methods to achieve perfection. 5 methods. 1 is filing, 2 is possession, 3 is control, 4 is automatic perfection, and 5 is temporary perfection. We're going to look at each one of them separately, starting with filing. What is filing? What's the purpose of filing? This purpose is designed to create a public awareness. You're telling the world, hold on a second, look here. This asset, I have a security interest in it. So public awareness of the creditor's interest in the specific collateral. By filing a financing statement with your state, the creditor essentially announces to the world their claim, helping to prevent other parties from unknowingly acquiring an interest in the same collateral. Because you're telling other people, look, I already have a claim in this property. If you're going to give them a loan, it's your problem. I have right to that property. So you file to let everyone knows about this. What do you mean by filing? You file with the state. So it's like a public record. Filing. Perfection by filing involves submitting financing statement to a public registry, which is a common method for securing a legal claim over most type of collateral, with the exception of deposit account and money. We're going to see what you have to do with that. So simply put, you file paperwork. Key element of performing the filing, documents to be filed, something called financing statement. The law requires a notice filing, not the actual filing of the security agreement, just the notice agreement that, look, we have a security interest in this. What should it include? The document must include the names and addresses of both the debtor and the creditor. It should clearly describe the type of collateral covered, specifying the debtor's inventory and equipment if it's, If there's a VIN number for a vehicle, specific ID for a piece of equipment, you want to specify as much as possible. Timing of the filing. You can filing before attachment. A creditor can file the financing before all the steps for the attachment before the security interests are finalized. So remember, you can file to perfect, but the perfection does not happen until attachment happen first. Why do you want to do that? Because you want to get the attachment and perfection as early as possible. Because if someone else also attached and perfect, the person that did it earlier will have the legal claim. So perfection upon attachment. The security interest is only considered perfected when it attaches to the collateral, meaning the creditor's legal claim become enforceable from that point. What does that mean? It means, let's assume you're selling an item and you want to perfect it. Even before you sell it, you can start the paperwork. You can file the paperwork, the filing paperwork, then you sell it, then the paperwork is already ready. So you attach and you file at the same time. Why? Because you want to perfect it as early as possible. This flexibility of filing before attachment is complete, so you can file before attachment is complete to allow the creditor to secure their interests as early as possible in advance to make sure they obtain the legal protection as soon as the attachment process is finalized. Why? Because whoever perfects first will have legal right to that asset. This proactive approach is useful in complex financial transactions where collateral involve multiple items or types of property. That's the first one. You gotta file. You can also have perfection by possession. It means they give you the collateral, and that's the best one. You have it in your garage, you have it in your home, you have it in your warehouse, secured. Perfection by taking possession, often referred to as a pledge, is a method where a secured party achieves a legal claim over certain type of collateral by physically taking the collateral. They gave you the furniture, the TV, the phone, the jewelry, their motorcycle, their boat, whatever it is, they gave it to you. Great, this is as good as it gets. This method is straightforward, and it's similar to the concept of used in pawn shops. Pawn shops is when you want to borrow money. You go in there, you give them something, your jewelry, ring, phone, whatever of value. You hand it to them, they'll give you the money. The process here, the creditor physically holds on to the collateral. They have it in their hands. By having the item in their possession, the creditor's security interest is considered perfected. It doesn't get any more perfected than that. This means their legal claim over the item is enforceable and recognized. Now, the owner can regain the property, one, when they repay back the borrowed money or fulfill whatever their obligation they have, which the collateral was pledged for, usually pay back the money. So this is the best way for the creditor. I have the item in my hand. You could also have perfection by control. Possession means you're dealing with physical item, clothing, furniture, TV, so on and so forth. Perfection by control. Perfection by control is a method used to perfect a security interest in investment property. Because if you have stocks and bonds, yes, you could have a stock certificate or a bond certificate, but generally speaking, people don't receive those anymore. When you have stocks and bonds, it's a computer entry somewhere on the server, held in an account with a brokerage firm or mutual fund company. Well, guess what you do under those circumstances? You have control, not possession, control. This method is relevant when physical possession is not feasible. Now, if they have security, if they have the stock in their hands, the certificate, and they want to send it to you or the bond, that's even better. Not really, because you have to make sure you don't lose it, but the fact that it's on a computer server somewhere, you could still have control over it. The secured party control over the investment property when they have the authority. Authority means the owner gives them the authority. They tell the bank, they tell the mutual fund, they tell the investment company that I'm given the authority to that individual over my account to direct the sale or transfer without needing any further instruction from the owner. You tell your brokerage firm that this individual, they can use my account, and you have obviously to give them that instruction in writing. For securities account, means stocks and bond, control is established when the owner instructs the brokerage firm or the mutual fund company to recognize the rights of the secured party in the same way they would recognize his rights. What does that mean? It means when they want to sell something, it's as if I'm doing it. Now, what if that individual abused this privilege? Then that's a different story. This includes complying with orders from the secured party regarding the account without needing additional approval from the owner. Example, Maria takes a loan of $50,000 from First City Bank. As a collateral, she offers a security interest in her investment account at Orient Investment valued at $75,000. She gave the bank control over her account. She cannot give them possession, but it gives them control. To perfect its interests through control, First City Bank arranges for the following. We want direct instruction. Maria instruct Orient Investment that First City Bank now has the authority to make decisions about the account's asset. Now, when would they make a decision about the account's asset? When Maria fails to pay the money. They don't do it just because they want to trade stocks. They only do it based on the agreement. Now, Orient Investments acknowledges this arrangement and agrees to act on the instruction, basically saying yes without needing any further instruction. Say, no worries. First City Bank calls us, the representative calls us, we will comply with it. Then we have something called automatic perfection. We looked at this earlier in the previous recording, but we're going to review it again. We could also have automatic perfection. That's 4 of 5. Automatic perfection is a concept under Article 9 of the UCC, whereas security in certain type of collateral becomes perfected upon attachment. So once you attach it, it becomes perfected without the need of any additional action like filing or taking possession. Remember, attachment is good, but you want to perfect it. Well, here you're going to have automatic perfection. This simplified the process for certain transaction. And I hope you remember when this happens. Two common instances of automatic perfection that often appear on the CPA exam: the PMSI in consumer goods and small-scale assignments of account receivable. Let's look at PMSI in consumer goods. Well, PMSI is the purchase money security interest. Occurs when the creditor sells the collateral on credit and retains a security interest, or the bank provide the funds, the lender provide the funds used by the debtor to purchase the collateral and retain a security interest in the collateral. Again, a review. Simply put, you go into a store, Best Buy. You want to buy a computer. Well, they would say, no problem. We will lend you money. Best Buy will give you the money to buy this computer. You're buying it on credit from Best Buy, and we are taking security interest in that computer. This is called PMSI. So they gave you the money, they're selling you the computer. Automatically, it's attached and perfected. Same thing if you go to the bank to take the money out. The bank says, okay, we want security interest because you're borrowing this money to buy that computer. And we looked at PMSI in the prior recording a little bit more in details, but this is where you have automatic perfection. Now, automatic perfection occurs for consumer goods, items purchased for personal, family, or household item. So when that happens, PMSI automatically perfected upon attachment. Remember, I showed you the 3 cars in the prior session, and I said you could be using this car for personal use, you could be using this car for business use, or you could be a car dealership and this car could be part of your inventory. So this automatic perfection only happens when you're using the car for personal use. If you are purchasing the item for your inventory or equipment, you must file to perfect. So be careful. If the asset buying, if you're buying this vehicle or the asset that you're buying is used for business purpose, or it's part of your inventory, you're buying and selling the item, then you have to file. Automatic perfection doesn't happen. It only happens if you're using this car to go on vacation, go shopping, take your family to events, so on and so forth. Also, automatic perfection could happen when you have a small-scale assignments of account receivable. This refers to the transfer of rights from a debtor to the creditors. When I tell you, you have the right to my account receivable. In cases where there is small-scale assignment, few account receivable, the security interest is automatically perfected. Let's take a look at an example. Emily purchases a new laptop for personal use from TechWord. The laptop cost $1,200, but Emily don't have the full amount up front. So guess what? TechWord agrees to sell the laptop on credit under the condition that they retain security interest in the laptop until it's paid in full. Do we have automatic perfection here? Absolutely. Automatic perfection as soon as Emily takes the laptop and the security interest attaches to it. It's automatically perfected. This means TechWords has legally enforceable claim without needing to file any additional document. We're assuming here that she's using it for personal use, and we mentioned this right here. This is important. So on the exam, they gotta be careful for what purpose Emily is purchasing this item. And this example demonstrates how automatic perfection streamlined the process for certain type of transaction. Temporary perfection. What's temporary perfection? This is a provision under the UCC that allows a creditor to maintain a perfected security interest in the proceeds of a collateral for a limited time period, usually 20 days. What does that mean? Sometime, let's go back to Emily here. Emily was automatic. Here we have automatic perfection. Let's assume Emily sells this laptop. Guess what? The proceeds that she received, she might be using them for something else. The tax store here, they have temporary perfection for 20 days. The situation arises when the collateral subject to the security interest is exchanged or sold. Any proceeds, you have automatic perfection by the creditor. When collateral with a perfected security interest is sold or exchanged, the creditor automatically obtains a perfected security interest in the proceeds. 20 days. This interest is temporary. From the moment the proceeds are acquired. What does that mean? It means you might have to go back and file. And this gives you what? Gives continuous production for the lender, for the person, for the party that made the sale. This temporary perfection ensures that the creditor's interest in the new asset is protected without any immediate need for additional action like filing a new financing statement. You might have to, but at least you have 20 days. Example, consider a scenario where Jackson has a car loan from Citibank, with the car serving as the collateral. Now, Jackson's car for the loan has perfected security interest in it. So it's Citibank have no concern because they have a perfected security interest. Guess what? Jackson trade that car in. Jackson decides to trade in this car for a newer model at the dealership. In return for his old car, he receives a credit which he uses as a down payment for the new car. Well, as soon as Jackson acquires the new car using the proceeds, the credit from the trade-in, Citibank's security interest in the new car is automatically and temporarily perfected for 20 days. So this 20-day window provides Citibank with a buffer period to take the necessary steps, whatever is needed, like filing new financing statement to perfect its interest in the collateral, ensuring the claim remain legally protected. So they give you 20 days, but you have to make sure to follow up on those 20 days. Let's talk about when the debtor moved to another state. The creditor's perfected interest from the first state is recognized as a valid in the new state for a period of 4 months. Let's assume someone from Pennsylvania moved to California. Guess what? Remember, you are filing with the state. So when you move to another state, the new state will give you 4-month automatic extension. Basically, they consider it valid in the new state, but you have to file in California. Now, the creditor will have to follow up in California and file. Why do they have to file? Because they want to have that priority in case something happened, priority to the interest. But the rule is you have 4-month extension until you file. To continue having priority and enforceability of their security interests in that new state, California, the creditor must take action to perfect their interest in that state within this 4-month window. And this provision ensures that the creditors has a reasonable amount of time to adapt to the debtor's change of address, change of jurisdiction, without immediately losing their secured interest. They don't want to lose their secured and security interests. Is that true? Partially true. Is it true in equipment? Equipment means equipment used in a business. No, it's not perfected upon attachment in PMSI in equipment. The answer is no. Is it PMSI in consumer goods? And the answer is yes. General lien on the property, not needed. Unsecured personal loan. No, it has to be consumer goods. Consumer goods means you purchase the item and it's for personal use, not business use. You're not using it in your business as equipment. You're not using it in your business as inventory. You might be saying, how about unsecured personal loan? But when you took that personal loan, you did not specify for what purpose. Unsecured, I mean, you could use it for anything. And when you use it for anything, the bank or the lender don't have attachment, or they cannot perfect it automatically. Therefore, unsecured personal loan is not the correct answer. The correct answer, it's a purchase money security interest in consumer goods. Make sure you know this. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you're studying for your CPA exam or business law. Good luck, study hard, and of course, stay safe and invest in yourself.